Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and something of a reality check for investors today. Nation, 2020 has been a wild ride and we're barely halfway through the year. Even with that February crash, investors have booked triple-digit returns on some of the hottest stocks. Shares of Tesla are up over 250% since the beginning of the year, and shares of Fastly, ticker FSLY, are up over 260% since recommending it in December. But now with a lot of that value sucked out of the market, investors are ravenous for anything that looks like a rebound play, looking for those cheap stocks that can keep producing those triple-digit returns. And it could lead to an epic regret for a lot of investors. Investors are looking at the shares of airlines, cruise companies, and others in those hardest-hit industries and seeing stocks still down 50 and 60% from the highs. The three stocks that I'll use as an example today would produce an average 159% return if they were able to retake those highs. But what I'm going to show you in this video is even in that best case scenario, these stocks might not get anywhere close to those previous highs. These cheap stocks aren't nearly as cheap as you might think. In this video, we'll look at some of those cheap stocks in airlines, cruise, and industrial. I'll dig into the financials to show you the hidden danger in these stocks and then reveal a price target well below what Wall Street is expecting. Before we get going though, I gotta send a special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I get it. You look at those hardest hit stocks and they look like screaming values compared to a market that's rebounded 45% from March. The cruise lines, the airlines, and the industrials look like your last hope for those triple-digit returns that other investors are bragging about. But just take one look at a few bank stocks, the hardest hit in that last stock market crash, and it becomes painfully clear you can't expect these stocks to bounce back to their previous highs. Shares of Bank of America are still half their pre-2008 highs, and Regions Financial is down 70%. Worse still, shares of Citigroup are still down 90% from that 2007 peak more than 13 years later. So I'm going to do just a little back-of-the-envelope math to get to that realistic stock price target for some of these cheap stocks. And when I do, I think a lot of you out there are going to be reevaluating the risk and return in these stocks and whether you want them in your portfolio. And the overhang in these is really coming from a triple threat: debt, new shares, and capacity. First, these companies are adding insane levels of debt just to stay afloat. Was that a cruise line pun? The IATA estimates debt at struggling airlines could balloon by more than $550 billion this year. That's 28% above last year's levels. And that debt is going to mean billions of dollars in interest expense every single year. Earnings are going to be reduced, and even if the carriers are able to make those payments, that money won't be going to growth or staying competitive. Now, along with that new debt, many of these companies are issuing hundreds of millions of dollars in new stock. That's going to mean those reduced earnings are spread across even more investors, so even lower on an earnings per share basis. Finally, for a lot of these travel industry stocks, as profitability depends on squeezing as many people as possible into a plane or a ship. Airlines need more than 3/4 of the seats filled in each trip just to break even, and cruise line profitability is around 17%, which doesn't leave much room for half-empty ships. Nation, even after we get a vaccine, estimates are that it could be between 40 to 60% effective. That's the average efficacy for the more common flu vaccine according to the CDC. Also in surveys, as much as half the population says it won't take the COVID-19 vaccine when it's available. That could mean just 25% of the population is going to be protected from the vaccine even after it's developed and delivered. That's going to mean continued infections and fear even in the best case scenario. Now, translated for these companies, that means you're not filling up that Airbus A380 anytime soon, not by a long shot. So let's take a look at these three factors, apply them to a few of those favorite cheap stocks, and then estimate an earnings per share number. I'll then take the historic price-to-earnings ratio to show you a realistic price target for each. Our first stock here, Carnival Corporation, ticker CCL. This is one of the most talked about coronavirus stocks, with investors dreaming of a 229% return if the shares make it back up to February's high of $52 per share. Now the tragedy here is that going into this year, Carnival was actually looking like a good turnaround play after years of weakness. And shares were up 19% from that October to January, and I put it into our 2020 dividend portfolio at exactly the wrong time. Carnival is the world's largest cruise company with more than 100 ships at the end of last year, but also a boatload of debt. More nautical puns. The company already owed nearly $10 billion in debt and is likely to double that just to survive. Carnival issued a $4 billion in debt in April at 11.5% and a $2.8 billion tranche at 10.5%. then another $1.3 billion in July as a second lien against its ships. Now at that time, management lowered its estimates for monthly cash burn to only $650 million a month through the second half of this year, but that's still a lot of money it's spending with nothing coming in. Now next I'm going to show you an estimate for sales through earnings, but the company was already paying nearly $200 million in annual interest expense. That could balloon to almost $800 million this year and $1.3 billion in 2021. Carnival also issued $1.25 billion in new shares in March, as well as making $1.75 billion of the notes convertible in 2023. So if earnings do bounce back, investors are going to be sharing them with a whole lot more people. Now I'm going to make a 2022 revenue estimate here because I can guarantee you there won't be a positive earnings next year. I'm expecting about $18.7 billion in revenue in 2022, which is 3 times what's expected this year, but still about 10% below 2019 revenue. Now, honestly, how that revenue and capacity picture is going to eventually work out is still anyone's guess. The cruise lines had already voluntarily pushed back their bookings, and the CDC went a step further on a ban through September. But here with Carnival and the other 2 stocks that we'll talk about, I'm going to be optimistic on the revenue side just to show you that even in a best case scenario, the stock valuations here on these might not live up to investor expectations. So on that $18.7 billion in 2022 revenue, I'm estimating operating income of $2.12 billion and interest expense of $1.25 billion. That's going to mean about $835 million in profits after taxes. Now take that $835 million and divide by the 900 million shares after those issuances, and you get just 93 cents per share. And remember, this is out to 2022 numbers. Carnival booked $4.48 in earnings per share last year, and the street expects it to get back to profitability with $1.08 per share in 2022. That's a little higher than my estimate. Either way though, we're not getting anywhere near that $4 per share earnings for a long time because of that debt and the higher share count. And now if you look at the historical price to earnings range where the shares have traded, from 5.8 times recently to as high as 11.7 times earnings over the last year, you get an idea of that price target. Applying even that 11.7 times PE ratio here, you get a stock price of just $10.88, which is below the current price. Now, I think the shares will trade for a higher PE on the hope of a return to normal, but you'd need a PE of 56 times to get the stock back to its pre-virus high. Even at a very pricey 25 times PE multiple, the shares would trade at just $23 per share through 2022. Now, that's still a tempting 50% return from here, but remember, these are on optimistic assumptions and well below that 229% return a lot of investors are hoping for. Shares of United Airlines, ticker UAL, opened the year at $87.90 each, which would be a return of 154% if it makes it back there. United recently reversed its policy on keeping that middle seat empty for social distancing, pretty much out of necessity. Now, data from Florida Panhandle shows the percentage of seats each carrier needs to fill on average just to break even here. United is the 3rd highest, needing a load factor of nearly 76% to make a profit. The company expects to fly just 40% of its schedule in August compared to last year, and that's with domestic flights back up to about 48% of last year's level. To survive, United is raising up to $6.8 billion against its rewards program and was approved for $9.5 billion through the Government CARES Act loan program. Now, the loans backed on its rewards program is an interesting one given that the company backed out of an earlier bond issue on its planes that would have meant double-digit interest rates. Now, the new debt here is going to be backed by revenue it collects selling miles to loyalty club members and comes at a lower 6.5% rate. All told, minus the forgivable portion of the government loans, the bonds are going to take the company's previous long-term debt from $18 billion to over $30 billion if it repays some of its scheduled debt to mature over the next year instead of refinancing it. Now, on top of that, though, United filed to issue 28 million shares in June, an increase of about 10% on its 260 million shares. Management expects this and the loans to get it to $19 billion in liquidity by September. Wall Street expects the company to book $30 billion in 2021 revenue, which would still be 30% under the $43 billion booked in 2019. I think this is going to be a struggle, even getting to this point, especially with those international flights, which is about 15% of business still being next to nil. The company is going to be depending heavily on the sales for its Mileage Plus loyalty program, selling those miles to members, which accounted for about $5 billion in 2019. But I'm not so sure that this revenue is secure when pricing gets competitive next year, but I'm going to use that $30 billion revenue estimate just to build out that best case scenario. I'm such a positive person. Now, if they can get to a 6% operating margin, and I think a safer bet would probably be closer to 5%, but a 6% margin would mean $1.8 billion in 2021 earnings before interest and taxes. I'm estimating interest expense at $680 million on the assumption that the carrier refinances some of its debt rather than paying off the maturities with cash and get to an after-tax profit of $885 million, which would mean $3.05 per share of earnings on that 290 million shares available. United has traded as high as 10.6 times on a PE ratio over the last year, which only gets it to a share price of $32.33 on that earnings estimate. Now, I would give it as high as a 15 multiple, which would take it to $45.75 per share on that investor enthusiasm for a rebound. Again, not bad at a 33% return, but far from what investors might be expecting looking at that 52-week high. Shares of Boeing were under pressure before the COVID outbreak and topped out at nearly $400 each last year, but even this year's peak of $347 in February would give investors a 94% return from here. The company is expected to get recertification for the 737 MAX any day now. That might be good for a quick boost to investor sentiment, but how much good is it long term if the airlines just don't have the business to need more planes? Besides grounding those flights during the outbreak, major carriers are laying off or offering early exits to tens of thousands of employees. You just don't bring these people back tomorrow, and fewer employees is going to mean permanently fewer flights and fewer planes. On problems around its 737 MAX, Boeing has seen operating profit in 3 of the last 4 quarters fall below the amount it owes on interest, and it's about to get a whole lot worse. The company borrowed a monstrous $25 billion in April on top of the $34 billion it already owed. That's going to bring interest payments to around $2 billion a year, and I suspect it's not done raising cash. The company hasn't had to issue new shares yet, but I wouldn't be surprised if it does happen this year or next. That 5% rate on the $25 billion emergency debt is still pretty low, but that interest expense is adding up fast. Analysts still expect the company can book sales of $67 billion this year, which would only be about 13% lower than last year, and then $88 billion in 2021. Now, I'm trying to build an optimistic picture here, but I think that's way too high. American Airlines has already told Boeing that it won't accept any MAX deliveries without financing. That's 17 planes Boeing's going to have to figure out how to finance through its capital division or third-party leasing company, and decisions like this by more airlines could seriously dent revenue. I think Boeing gets to $85 billion next year if it's lucky and the stars align. On a 7% operating margin, that gets the company to about $6 billion in earnings before interest and taxes, then minus $2.1 billion in interest, and it gets to $3.3 billion in net income after taxes. On 565 million shares, that would give us $5.84 per share. The MAX issues drove Boeing to an earnings loss last year, though analysts do expect it to return to profitability by 2021. Street consensus is for $6.03 in per share earnings, just slightly above my estimate. As earnings tumbled over the last year and the share price held up, that meant the stock traded for between 21 to 50 times on a PE basis, but don't expect these multiples as the company claws its way back up to profitability. I'd say a PE ratio between 20 to maybe as high as 35 times earnings is more realistic if investors can get really excited about the shares and the economy bounces back fast. Now, that puts the shares as high as $200 each, but that's on a very high multiple, and the company's earnings would just have to grow into that to justify it long term. Now, notice that all these estimates are still above where the stocks are currently trading, and not a bad return either, so in that respect, they are cheap stocks. But remember, we've used some optimistic numbers to find a best case scenario, so prices might have a hard time reaching these levels. Just understand that if you're thinking that these value stocks are going to double quick for a triple-digit return and make you rich, it just isn't going to happen. Click on the video to the right for 3 ways to find truly cheap stocks, 3 methods I use to find value stocks that won't let you down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.